Good afternoon, everybody, and thank you for attending the monthly market monitor on May 10th, 2023. Again, the first meeting since the Aaron Rodgers trade. I know that's maybe a different subject, but thank you all for joining. And I'll go through a couple of big economic updates and a couple of outlooks on rates and economic conditions in 2023 and beyond. And again, like it says in the rundown here, any questions, please type them in the chat feature, and we can address them at the end of the presentation. First, a couple of labor statistics that are pretty important to the marketplace. Unemployment rate. Again, U3 and U6 aren't commonly known. The U3 is a typical unemployment rate, which captures folks who are actively seeking work. So to be counted in that particular metric, you had to be unemployed and actively seeking work. But again, this is the lowest number it's been since 1969, under 4%. In the state of Wisconsin, I believe it's about 2.8%. So from a labor perspective and a jobs perspective, it's very, very strong, very, very low unemployment. And the U6 number, that includes underemployment. So again, the analogy of a PhD working at a fast food place, or somebody who is, waiting for a real job and working at a job they're overqualified for while seeking new employment. That number is also at the lowest number been recorded since looks like the mid 90s. That came at 7.4%. So very, very strong indications from a labor perspective. And again, the U3 rate is the lowest number we've seen since the end of the 60s. Also, job openings. This is something that many businesses talked about prior to even the COVID lockdowns, is a lack of qualified or skilled workers for their job openings, whatever the job may be, whether it be in finance or banking or management or engineering or welding or plumbing, whatever the case may be. So you can see thousands of jobs openings. Again, we're off the peak in the middle part of 2022, but still well above the green trend line, which tracks about 13 years, 14 years. But it is kind of regressing to the mean, but still, this does show very, very low unemployment and a high number of jobs available, which is part of the reason of the inflationary pressure. Ergo, businesses need to pay up to get qualified personnel to work. Again, based on these jobs numbers. Also with layoffs and discharges, again, this is a 3-month average, and the most recent long-term economic shutdown was the Great Recession in 08-09 with the subprime housing crisis and the subsequent fallout with Lehman Brothers collapsing and Bear Stearns and all the mergers and acquisitions that the big banks took. And you can see since then it's pretty much range bound, with the exception of the COVID lockdowns and the big discharge there, and all the emergency funding that came in, federal assistance on unemployment insurance in combined with state insurance. So that was a phenomenon we hadn't seen before, with both programs were both eligible, recipients are eligible for both federal and state assistance. You can see now that is kind of moving back up to almost range bound to the area from 2011 to 2020. So it's, quote unquote normal, I guess, level of layoffs and discharges. But again, it has creeped up pretty significantly over the past several months. Most of those are Silicon Valley and technical related. And again, there is a little bit of logic to that. In fact, because of all the folks going remote during the pandemic, the marketplace had a big demand for technical oriented and trained people. Now that we've kind of gone back to the workplace in some cases and gotten accustomed to this new normal, that type of personnel isn't quite in high demand, as high demand as it was. Ergo, the layoffs are affecting that sector more than others at the moment. This is another issue here that I think is very alarming. And again, it has a lot to do with just the baby boomers retiring. Again, the working age population is near historic low levels. And again, working age is defined as 15 to 64. Now, we all know, growing up mowing lawns and whatever we did to grind out some money, that the youth today don't, behave the same way we did 40, 50, 30 years ago, 20 years ago, whatever the case may be. And this is kind of a demographic shift given the retirement of the baby boomer generation. And again, going back to the 70s and 80s, you see the dark blue line, working age. That was when the boomers were becoming of age. They're in their 20s and 30s and becoming into management. And then that lull in 1990 and a rebound around 2000. That's kind of like the millennial generation. And again, the millennials kind of came of age around the year 2000, hence the word millennial. But you can see two big demographic waves there. First, the baby boomers, next, the millennials. And now the baby boomers are retiring. So that little light line, that projection there is total working people. And those are folks who decided to keep working despite meeting the age of retirement. So that big spike happened at the start of the pandemic, or expect the start of the pandemic. But now they're hanging on, but wanting to hang it up. They want to get out. They want to retire. They want to move to Florida, not work anymore. So that big spike is expected to come down again. But the projection of replacement workers is very, very low, which is also an alarming trend for people looking at rate forecasts on inflation in a labor perspective, that the labor costs will continue to go up, given the lack of eligible workers. Year-over-year growth on average hourly earnings is still above the 3% number, well above 3% number. You can see how much it spiked there with the COVID pandemic lockdowns and the subsequent rebounds, but it has come down significantly from the really, really, really high levels we had a while ago, but we're still over 4%, which again is underpinnings of inflation. And the Fed again met last week and raised rates again, but did signal that maybe this is it, maybe this is the top, is data dependent, and all the wordsmithing they can possibly do. At the press conference after the Fed meeting, they're really careful not to kind of play their hand or show their hand in any way. But again, this is still an alarming trend from a labor perspective on inflationary pressures out there. And again, part-time work for economic reasons. These are full-time employees effectively who have a second job just to make ends meet. So you can see that the part-time employment for economic reasons now is a lowest it's been, flirting with the lowest levels going back to the 50s on this chart. So, it shows maybe, the economy isn't so bad given this metric. But again, like I mentioned earlier, with the boomers retiring, they're saying, forget it, I'm out. I'm done working. I've had enough. Take this job and shove it. Whatever metaphor they're using it in spades, because they are retiring at a very, very fast rate, with replacement workers just not there at the moment. This is another alarming trend, unfortunately, about labor productivity versus unit labor costs. And the 1 year change, again, the blue line is the labor costs, up 6%, 5.8%, but productivity is actually down. So effectively, you're paying more for less, which is a pretty bad trend if you're a business owner. Usually you pay more for more, not more for less. And then the quarterly number, again, these are quarterly statistics that are annualized, but you can see the divergence in 2022 leading up to early part of 2023 in unit labor costs versus productivity. And this is among the widest splits we've had, excluding the pandemic numbers. So again, it's an alarming inflationary trend. And if the labor costs don't start to moderate, then I don't know if business startups will continue at the clip we've seen in the last 25 or 30 years. The cost of capital now is so much higher, giving the 5% interest rates hikes we've seen in the last 14 months. So again, capital, employees, a cost of doing business, maybe even security. If you're in a major city, it's just very difficult to start a business, giving all these underpinnings of explicit costs that are much higher than they were, 5 years ago, 10 years ago, whatever the case may be. Inflation outlook. This is after the Fed meeting we had last week, the Fed announcement of raising rates to 5 to 5.25. This is the outlook for the rest of the year. And again, the implied rate in the middle there, that's what they expect the Fed to do at each of the subsequent Fed meetings the rest of the year and into 2024. What this is forecasting is effectively a 75 basis point cut by Christmas. is what the futures market is pricing in. Now, the Fed did talk about at their meeting how it's data dependent. The economy will kind of steer their guidance going forward. The market does believe that the Fed's going to cut rates. Ergo, the yield curve is inverted like it is. But the Fed has said that inflation is still sticky and it's still higher than they want, much higher than the 2% target. So they keep saying data dependent, but again, that's an overnight interest rate and short-term interest rate play on how they do reserves and handle the overlying interest rate indexes, which are short-term. But the personal consumption expenditure is what the Fed's preferred measure. The headline of the core numbers, again, the core, like on the core CPI, strips out food and energy, but you can see how high it was in 2022. And again, the forecast going through the end of the year and into 2024, it takes nearly an entire year for it to reach the 2% target. And even the core CPI is expected to not reach the 2% target until 2025. So it's still going to moderately overshoot the numbers. And I think what's really alarming about this is the embedded hikes that we've already absorbed in the last 18 months or 2 years. So again, this is another 3 and 4% on top of a 9% runoff last year. So the combined 2-year numbers are not attractive at all as far as inflation is versus historical norms we've had over the past 15 or 20 years. Again, shelter costs are what's most alarming here. The gray line is housing, and you can see how much that has risen since the pandemic started back in 2020. It kind of shallowed out there a little bit, but has really risen very quickly in the past 18 months or so. The dark line, the core goods, has come into own about 2% down again. And the core service, excluding housing, again, is flatlined since May of 2021. The CPI numbers, again, the services is very alarming in commodities. Again, we know commodities are very volatile. That includes a lot of natural resources, natural gas, copper, iron ore, etc. But the commodities run up as a result, in part, from the war in Eastern Europe with Russia and Ukraine, and the subsequent political economic sanctions, currency wars, and etc. China as well, with the currency manipulation, them threatening to leave the dollar and trade in their own currency and yuan or an alternative to the dollar. That is certainly going to have a big effect on commodities as we go forward. But again, the services number, the dark line services is very, very expensive. And like I talked about earlier, that has a lot to do with labor costs in the service industry because you can't really replace a service without employees. Like you can't go to someone's house and install a new air conditioner without someone who's willing to go there and do it. So again, the services inflation is very alarming as well. Used car prices, again, this is the index value. This isn't necessarily that used car prices are coming down, but they are coming down. But the CPI is a bunch of components, but used cars is a big, big driver in the consumer price index. And again, the index valuation devoted to just used cars is off the peak. But as you can see, it is still well above the trend line we had from 17 to 2020. So still a lot of work to do on used cars right now. The supply chain issues with new cars, with the chips that we had problems with a year ago, 18 months ago, are not gone, but they have been mitigated. But effectively, a $50,000 car, which is a lot what a new vehicles cost now, with high rates, a lot of people can't afford a new car. So they're going only to used cars, which is in fact, in part, keeping the used car market up in price. And again, you think you'd go and negotiate yourself a deal with a used car guy. Based on this chart, the average days that a car rolls off a dealer lot is among the lowest we've had going back to 2019. So under 30 days, 40 days of inventory roll is pretty typical. If it is 90 days, it's pretty typical before they get alarmed and start doing discounts on inventory. But if used car dealers are turning iron around at 35 days or so, they're happy with it and they're not going to negotiate because the next guy will buy it a couple of days later. And that's what a lot of the consumers are facing on the used car side. Same with rent and owner's equivalent of rent. So effectively mortgages. You can see how high this has risen, in part from rates. A 30-year conforming mortgage now is between 6 and 6.5. It's been trading in that range now for several months, 8 or 9 months or so. And the percent change from a year ago is approaching 8 and 9%. So again, that portion of the CPI number is what's kind of dragging up inflation pressures. And again, the CPI number came out this morning, and the core number was 4.9%, and it's down from 5% in March. So a lot of the analysts are pleased with the direction, and I am pleased with it too. But again, remember, it's 5% off of a 9% previously. So the embedded higher costs may be here to stay. And I picked a couple of specific indexes here, shelter and food, which are both above the all items less food and energy. So again, the straight line CPI print 4.9%. You can see the core numbers, food and shelter, are still well above that number. So the stickiness is what's pretty alarming here. And again, in 2021, the consumer expenditure number, the 2022 figure doesn't come out until September of 2023 because it's always a one-year analysis. You can see housing, transportation, and food, and that's about 63% of a budget. And $66,900 is what a typical consumer spent in 2021. Now, to make this list, it's either head of household, single parents, or a married couple who make this chart. So college kids making $15,000 at the restaurant are not included in this particular metric. These are head of household tax filers. So $66,900 is the average spent in these households in 2021. So I'm curious, 2022, what does the number show? If 9% is the number, again, that's $6,600 more. We're talking $72,000. And again, wages haven't kept up that quickly. So ultimately, more and more money is being devoted to housing and food, ergo crowding out everything else, which is where the economy is in a lot of cases. Consumer spending, again, you can see it's pretty much a straight line, straight slope, excluding the COVID stuff. You can see the slope from 2011 to now is about the same trend line we've had. So again, a very measurable, predictable number given stable increases in inflation. Residential housing starts, you can see this start to decline recently. So very, very high numbers in 2022. We had high commodities prices. Some labor market construction was still pretty available, but you can see housing starts have been down pretty sharply the last several months. And homes sold in all metro areas, again, have rebounded in the last month or so, but we're well off the peaks, and the trend line is down again. But in going to the whole period back to 2020, it's pretty much range bound. So hopefully a silver lining side is that trend line continues up to the gray and starts to moderate a little bit. But, the volatility we've all enjoyed or not enjoyed, all lived through the last 18 months with a 5% rate hike in short term has certainly had an effect. And again, it's going to lag a little bit before we really know if the effect the Fed wants is going to materialize or not. This is another one, commercial property price index. You can see how it's turned over in 2022 and started to come down. I know New York City and Chicago, San Francisco, for example, a lot of the big, trading firms, brokers, bankers, high-end businesses where employees make $200,000, $300,000, $400,000 each went remote, and they aren't coming back until mandates were issued, in the last several months. But New York City, Chicago, and San Francisco are all expensive cities, and they have those kind of people, going to lunch and spending $100 on hors d'oeuvres. That hasn't happened in the last 18 months. And the businesses are really suffering. And, businesses are saying we don't need to have people in person. We can do it remotely. We don't have to pay that $15,000 in rent. It's just not economically viable. We quit. We're out. So office space, retail space, commercial real estate in major cities might really start to correct. And a lot of analysts believe this is the one that's going to cause another 08, 09 style crisis, but this time with commercial real estate, not with residential real estate. Time will tell. There is talk already about converting some of these businesses to, residential. Again, given the homeless problems we have, some of the economic migration we've had internationally with new immigrants. So there's already talk of converting some of those properties to residential. But again, that takes a lot of investment in a lot of actionable commodities, which also will be expensive. But it is an option for them to consider. Each locality have to approve that on their own. But this is an alarming number and a lot of room to correct with prices on commercial property. GDP numbers, again, came down. What I think is alarming here is that the inventory section, the gray number on the Q1 was well down. So, if there is another supply chain issue with China, if we get sideways with them, with Taiwan or something, with a lack of inventory, we blow the inventory in the Q1, there won't be an actionable supply chain to fill it quickly if there is another kind of setback, a political setback. So buckle your seatbelts if that happens. But hopefully the GDP numbers will continue to at least to hover in north of zero. But if 1.5%, 2%, we can get through this correction with high rates, many people will consider that a victory and a so-called soft landing for the Fed, where we don't go into recession, but we just have very, very slow growth. And that's probably optimum perspective from the Federal Reserve side. Here else is our near-term concerns. Again, we've all talked a lot about, the soft landing, the crash landing, all the different economic interests of what may happen. But, muddling through it again, we talked a little bit about all these issues today about the labor market. If it continues its strong momentum, we get jobs filled. The job numbers are coming down, but again, the strong labor market with low unemployment and plenty of people available for work, it's just a mismatch of training perhaps. If that can get done and that can get handshake with people looking for work at the right price, then we can muddle through this and make it with maybe a 1.5%, 1% quarter here and there through 2023. But not have a big correction like a negative 5% GDP print or something like that in the fall of 2023. Again, energy prices need to stay down for that to happen. We tapped the petroleum reserve, I know, earlier in the year to keep prices down, and energy prices have come down. So perhaps we can refill, the reserves at a cheaper number, and it won't hurt us too much, from a budget perspective. But recession is looming again if inflation remains persistent. And again, 4.9% is better than 5%, and it's better than 9%, but it's not 2%. And a lot of analysts have said many times that going from 9 to 6 is easier than going from 4 to 2. So, we'll see where we go again. And with the labor mismatch and the boomers retiring, it's going to be a tough road to hoe, but I'm not entirely pessimistic. I think there may be a slight recession and maybe, some slow, low growth. But if we keep energy prices low, I think every sector will benefit from that. But again, time will tell. And again, that has a lot to do with the war in Ukraine and Russia. If China makes a move on Taiwan, I know these are political events which are really hard to measure, but these are very important components in 2023 as we go forward. Next is the fiscal cliff, the so-called fiscal cliff. Again, the budget is according to the Constitution, appropriations are done in the House of Representatives, and the President and the Senate, will do markups, amend it, negotiate it. But at the moment, there's a lot of people drawing lines in the sand and threatening we're not going to talk and all this. So it can be very, very compelling. Issue in the marketplace if they don't get a deal done and the debt ceiling is breached. So hopefully that won't happen. These are a couple of options here that may happen. Item 3 and 4 are probably the most unlikely. 3 being changes to Social Security and Medicare parameters. And again, after President Obama became president, when Paul Ryan was still in the House, they had that Simpson-Bowles Commission, but there's no teeth in it. it was just a bunch of guys talking about how to trim the budget. There was no actionable recommendations that came out of there. It was just, it was like an exercise in a college class. Until you get teeth in it, you're not going to change the budget. So the COVID spending has been embedded. I know, the House wants to go back to the pre-COVID trend line of the budget and start from there. Again, there are, people who have gotten involved in these federal programs, and they're probably not going to unwind anytime soon. So they're saying, how can we unwind it when we've hired all these people and have all these commissions structured to administer the program? So it's going to be interesting for sure. No matter which side of the equation you come on this, it's going to be a very, very volatile, I think, couple of weeks until June. Expected to be June 1st or June 4th when the money so-called runs out, and something will have to be done on a short-term basis. Again, yield curve month over month, you can see, yields are up about 45 basis points in the short end, 95 in the 1 month portion. So again, that's a very, very high move. And again, when the Fed did raise rates again a couple of weeks ago, and again, the forward path is likely that they're either at the peak or near the peak. And again, but still the inversion exists from 2 to 10 years. So again, the market is predicting that the Fed will cut rates given the outlook that the marketplace is showing. Year over year, you can see how much the short end has come up. 400 basis points on the 1 month area. And again, the cash number has been about 500 basis points up on a year over year basis. Curiously, the 20 year is only about 45 basis points, and the 30 year is about 60 basis points. So those have been pretty tame. Again, the long run investors and the long run inflation people pretty much measure off the longer rated treasuries, 10, 20, 30 year. With Europeans and Japan being negative interest rates until recently. So to them, a 3.5% return is pretty attractive given the alternative of negative 1%. So a lot of international money is parked longer out the curve, especially with the dollar being the reserve currency. And again, if that does go away, which I don't envision that happening in the short run, meaning in the next 2 to 3 years, but they can start planting the seeds to go away from the US dollar as a reserve currency. But until then, they're stuck with it. And I think that, the debt rollover is the biggest issue for us. As debt is rolling off, we have to reissue it at really high rates, and the interest on the debt becomes a bigger and bigger component for our budget domestically. 2-year treasury yields, again, off the peak of north of 5%, and they're down to about 4, a little over 4%. So that's a 1% correction in a very short period of time on the 2-year treasury yield. So again, that's the market saying that the Fed is overcooked, they're done, they're stopping. That's what they're indicating from their buy-sell pressures on the 2-year treasury. The longer 10-year paper has been pretty much range bound. It hasn't gotten north of 4.5 in all of 3 years. It flirted with 4 a couple of times, but now it looks like it's 3.5%. But again, because the curve's inverted, typically 30-year mortgages are priced off 10-year treasuries. But 6.5, that's 300 basis points above the benchmark metric, which is really wide. But again, given the inverted curve, that's about where we'd expect it to be. But if the 3.5% treasury, that would assume that cash is about 2.5%, so 1% slope from cash to 10. If that were the slope of the curve, then yes, 30-year mortgages might be 4.5% instead of 6.5%. But unfortunately, the inverted curve is kind of juking the stats, so to speak, on where the stuff up to 10 years should trade. These are just a couple of generic securities. Again, a new production 15-year security will yield you 4%, give or take. And all these different average lives are assuming X prepayment speeds, but 65 basis points above a like-term treasury is about where a new production 15-year paper is trading. And 30-year paper, 4.5 coupons. Again, you're 130, 120 over like-term treasuries. But again, it's kind of a tough pill to swallow when cash is yielding 5+ to extend out 10 years at 480. So again, a lot of strategy with an inverted curve is to extend your assets. in anticipation of rates coming down. But again, there's a big story to that, and inflation is still very high. So it's a risky proposition now versus previously in 05, 06, when the curve was inverted prior to the housing crash in 08, 09, extending then. It was maybe a better proposition than now because the inflation was not as persistent then as it is now. That's all I have for today. If anybody has any questions, I didn't see anything in the chat. Okay, I think that is a wrap. Thank you all for attending, and we'll see you next month.